Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today I will be talking about a stock that I came across while going through the Japan Company Handbook, and that stock is called Sand Holdings. Sand Holdings has a strength in large funerals, such as corporate funerals, and operates a number of large-scale funeral halls. The company also engages in funeral-related businesses, including flower arrangements, catering and cascades, the plots, and cemeteries. Sand Holdings is targeting to open 13 new halls, mainly in East and West metropolitan areas in the next 3 years. The company is also trying to foster new business such as restaurant business and nursing care business, and expand the categories of services such as support before and after funerals. Now that we have a brief understanding of Sand Holdings' business, let's review the company's fundamentals by focusing on its key ratios and look at the company's discounted free cash flow DCF analysis to find the intrinsic value of the company. So let's dive in and review Sand Holdings. Hey guys, let's look at the key ratios. I'm on Morningstar looking at Sand Holdings. Under key ratios, I have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2012, the company brought in about 18 billion yen. In the year 2021, it brought in about 18.8 billion yen. Over the past 10 years, the company's revenue has slowly been trending upwards. Next, looking at the operating margin. The operating margin is what's left with the company once we subtract the cost of goods and operating expenses from the company's revenue. Back in 2012, the company's operating income was about 2.4 billion yen, and for the year 2021, it was about 2.6 billion yen. Similar to the trend of the company's revenue, the company's operating income over the past 10 years has slowly been trending upwards. Next, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it has paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2012, the company's net income was about 918 million yen, and for the year 2021, it was about 1.6 billion yen. Over the past 10 years, the company's net income has always been positive, which tells us that the company always reported a profit. We do see a drop off in the year 2016. This could have been due to a one-time write-off or a one-time loss that the company recorded, which caused the company's net income to drop off in that calendar year. After that, looking at the dividends per share, back in 2012, the company paid out about 20 yen per share as dividend, and for the year 2021, it paid out about 32 yen per share as dividend. Over the past 10 years, the company's dividends per share stayed consistent from 2012 all the way through 2016. Ever since 2016, the company has been hiking its dividends every year, which is good news for existing shareholders, as when a company pays out dividends, it is actually a way for the shareholder to receive their capital back in the form of dividends. Next, looking at the shares outstanding. Back in 2012, the company had 11 million shares outstanding, and even today, the company has 11 million shares outstanding. Over the past 10 years, we can see that the shares outstanding number has stayed the same, which is good news for existing shareholders, as this tells us that the company has not diluted the existing shareholders' ownership within the company. Next, looking at the book value per share. The book value is what we get when we subtract the total liabilities from the company's total assets. So essentially, book value is the same as shareholders' equity. Back in 2012, the company's book value was about 1,723 yen per share, and for the trailing 12 months, it's 2,639 yen per share. Over the past 10 years, the company's book value per share has always been positive, which tells us that the company always had more assets than liabilities on its balance sheet. And we can see that the book value per share is trending upwards, which tells us that the proportion of the company's assets is growing in comparison to its liabilities. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Back in 2012, the company's free cash flow was about 1,177 million yen. And for the year 2021, it was 1,122 million yen. I will be using the 1,122 million yen figure for my discounted free cash flow DCF analysis. Ideally, we want the company's free cash flow to be positive, staying steady or increasing. And we can see that there were a couple of years back in 2016 and 2017 when we saw a drop off in the company's free cash flow due to the excessive capital spending that the company did in those years. However, over the past few years, we can see that the company's free cash flow has been positive and stayed fairly consistent. Next, looking at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2012, the company's net margin was about 5.02%, and for the trailing 12 months, it's about 10.19%. What this means is every $100 that the company made over the past 12 months, by the time the company paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had about $10.19 left as pure profit. Next, looking at the return on equity. The return on equity is the ratio of the company's net income to its shareholders' equity. Warren Buffett prefers to invest in securities that have a return on equity of 8% or greater every year for the past 10 years. For majority of the past 10 years, the company's return on equity has been less than 8%. This is primarily because the company has little to no liabilities. So when we look at the equation of assets being equal to liabilities plus shareholders' equity, the fact that the company has little to no liabilities makes the company's equity portion large. And when we compare a net income to a large equity portion, we're bound to get these smaller return on equity numbers. Next, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. Benjamin Graham, the father of value investing, preferred to only invest in securities that had an interest coverage of 5 times or higher. Back in 2012, the company's interest coverage was about 35.61 times. For the year 2019, it was about 327.4 times. And we do not have a number for the trailing 12 months because the company's interest obligations are insignificant compared to the company's income. Now let's look at the company's financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to see the company's current ratio to be greater than 1. It's even better if it's greater than 1.5. A current ratio greater than 1 tells us that the company has more than enough current assets to fulfill its current liabilities. Back in 2012, the company's current ratio was about 1.39, and for the latest quarter, it's at 3.29. Over the past 10 years, the company's current ratio has always been greater than 1.0. Next, looking at the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. Ideally, we want to see the company's quick ratio to be greater than 1, as that tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2012, the company's quick ratio was about 1.19, and for the latest quarter, it's at 2.91. Over the past 10 years, the company's quick ratio has always been greater than 1.0. Next, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. A financial leverage of 1.0 tells us that all of the company's assets are financed via shareholders' equity. When we do see a high financial leverage ratio, it tells us that the company is taking on more debt and more liabilities. Back in 2012, the company's financial leverage was at 1.33, and for the latest quarter, it's at 1.13. Over the past 10 years, the company's financial leverage has slowly been decreasing and has stayed fairly consistent over the past few years. Finally, looking at the debt to equity ratio, this ratio compares the company's total debt to its shareholders' equity. Ideally, we want to see the company's debt to equity ratio to be less than 1.0. It's even better if it's less than 0.5. Back in 2012, the company's debt to equity ratio was at 0.15, and for the latest quarter, it's at 0.01. Both the financial leverage and debt to equity ratios point out that the company has little to no liabilities, and the current and quick ratios point out that the company is very liquid and is not in a liquidity bind. Now let's look at the efficiency ratios. The first item on the list is the days sales outstanding. This number gives us an idea of how many days go by from the day the company recognizes its sale to the day it actually receives cash for that service rendered. Back in 2012, the company's days sales outstanding was about 10.17 days, and for the trailing 12 months, it's at 8.55 days. Over the past 10 years, the company's days sales outstanding number has stayed fairly consistent. Ideally, we want the company's days sales outstanding number to be staying steady or decreasing. What we do not want to see is a company whose days sales outstanding number is growing rapidly, as that tells us that the company is playing tricks with its accounting in order to aggressively recognize its sales so that it can report an inflated income number on its income statement. However, we can see that Sand Holdings is not playing any such tricks, as the days sales outstanding number over the past 10 years have stayed consistent. In fact, the numbers have been declining over the past few years. Next, looking at the days inventory. This number gives an idea of how many days does Sand Holdings products sit in its inventory before they're sold. Back in 2012, the company's products sat in its inventory for about 4.96 days, and for the trailing 12 months, that number was about 3.57 days. Ideally, we want to see the company's days inventory number to be staying steady or decreasing. And we can see that over the past 10 years, the company's days inventory number has slowly been trending downwards. Next, looking at the payables period. This number gives us an idea of how many days does Sand Holdings take to pay its suppliers. Back in 2012, the company took about 25.16 days to pay its suppliers. And for the trailing 12 months, that number was about 12.15 days. Over the past 10 years, the company's payables period has slowly been decreasing. Ideally, we want the company's payables period to be staying steady or decreasing. What we do not want to see is a company whose payables period is growing rapidly, as that tells us that the company is holding on to its cash in order to artificially inflate its cash flow numbers on its cash flow statement. However, we can see that over the past few years, the company's payables period has been decreasing, which tells us that Sand Holdings is not playing any accounting tricks on us. Finally, looking at the inventory turnover. This number gives an idea of how many times does Sand Holdings' inventory go through its system in a calendar year. Back in 2012, the company's inventory turnover was about 74 times, and for the trailing 12 months, it's about 102 times. Ideally, we want to see the company's inventory turnover to be staying steady or increasing. And we can see that over the past 10 years, the company's inventory turnover has slowly been increasing. Now let's compare the company's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. San Holdings PE is at 8.1, whereas S&P 500 is at 25.3. San Holdings price to book is at 0.6, whereas S&P 500 is at 4.5. San Holdings price to sales is at 0.8, whereas S&P 500 is at 3.2. San Holdings price to cash flow is at 7.8, whereas S&P 500 is at 18.1. And finally, the dividend yield. San Holdings has a dividend yield of 2.2%, whereas S&P 500 is at 1.4%. So overall, we can see that in all these valuation metrics, San Holdings Inc. is undervalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for San Holdings. Over here, I pasted the company's 2021 free cash flow number that I got from Morningstar, which is at 1,122 million yen. I'm using the annual growth rate of free cash flow to be 5%. What this means is I expect the company's free cash flow to grow at 5% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I expect this investment to give me a 10% return. I'm using an annual growth rate of free cash flow to be 3%. What this means is I expect the company's free cash flow to grow at 3% every year after the 10-year mark into perpetuity. The company has 11 million shares outstanding and $0 in its long-term debt. After taking all of these inputs into account, we get the company's intrinsic value to be about 1,697 yen per share. When we compare this intrinsic value to the company's current stock price, which is at 1,497 yen per share, we can see that the company's current stock is trading about 12% below the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about 8.8 billion yen. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the company's intrinsic value to be about 18.7 billion yen. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about 1,697 yen per share. Now, if we add the company's book value to the company's intrinsic value, then we get that number to be about 4,336 yen per share. Now, if you disregard the perpetuity component, in other words, if you think that San Holdings is only going to grow for the next 10 years and then it'll cease to exist and we'll have to liquidate that company, then we get the intrinsic value without the perpetuity, but including the book value, to be about 3,436 yen per share. In conclusion, San Holdings is an undervalued security. The company has strong fundamentals and has little to no debt. Additionally, no amount of technological advancements such as AI, machine learning is going to replace the demand for funeral services in the future. Lastly, Superior North has 100 shares of San Holdings in its portfolio, and if the company's share price drops further, then I would consider adding more shares of San Holdings to Superior North's portfolio. Hey guys, that is all I had for you this week. Hopefully you found this video on San Holdings interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which Japanese stock I should review next, please leave it in the comment section below. I would greatly appreciate it. Thank you.